Let's talk about Prop 19 loopholes in California. Because what most families don't realize is that there are loopholes, and missing just one can trigger a hidden property tax trap that costs you tens of thousands of dollars every single year. Prop 19 loopholes aren't talked about openly, but they absolutely exist. And if you don't understand them before you sell or transfer a family home in California, the damage is permanent. You've just been handed the keys to your family home in California. It's a place filled with memories, maybe decades of them. But before you make a single move, before you even think about what to do with those keys, you need to know about a state law that has turned this beautiful gift into a potential financial nightmare. What used to be a straightforward blessing can now trigger a surprise tax bill that could cost you tens of thousands of dollars year after year. This isn't a scare tactic, it's the new reality under Proposition 19. So, what does this new world look like? Prop 19 didn't just change the rules, it tore up the rule book. If you inherit your parents' home, that old parent and child exclusion basically is gone. It is replaced by new, incredibly strict conditions, keeping any shot at that low tax base almost impossible. There are several non-negotiable requirements. First, the home must have been your parents' principal residence when they passed. Simple enough. Second, and this is the part that changes everything, you must move into the property and make it your own principal residence within 1 year of inheriting it. This isn't a suggestion. You have to physically live there. Third, file for the homeowner's exemption to prove it. Fourth, file the Prop 19 exclusion on time. If you're finding this video informative and valuable, please subscribe to our channel for more updates on estate sales, probate procedures, and real estate strategies in Orange County. So what if you can't meet the non-negotiable requirements and timeline? The property is immediately and completely reassessed at its full current market value. The low tax bill your parents enjoyed for decades vanishes overnight. And what about the family vacation cabin or the small rental property your parents owned? Under Prop 19, the exclusion for any property other than your parents' primary home has been eliminated. Now there is a very narrow exception for family farms. But for virtually everyone else, if you inherit a second home or a duplex, it is automatically reassessed at full market value. Period. Subscribe for more education like this, and if you need clarity now, connect with us directly. This is where we get to the core of the problem, the hidden trap that catches so many families completely off guard. You might be thinking, okay, the rules are tough, but if I follow them and move in, I'm safe, right? Wrong. This is the most misunderstood part of Prop 19. Even if you do everything right, pack up your life, move in your parents' old home, and file the paperwork on time, you are still not guaranteed their old tax bill. Prop 19 created a value limit. Here's how it works. You get to keep your parents' old assessed value. And on top of that, you get to exclude $1 million of the current market value. Any value above that combination gets added to your tax bill. So let's use a real-world story. We can call them the Garcias. Their parents bought a home in quiet LA suburb in 1980 for $150,000. After 40 plus years, its assessed value only crept up to $300,000 thanks to Prop 13. Their annual property tax bill is a manageable $3,300. Fast forward to 2026, the neighborhood is booming. That same home is now worth $2.5 million. The Garcia family inherited that. One sibling lived out of state, the other family an hour away. They decided to keep the house as a rental just like they always planned. Because no one is making it their primary residence, Prop 19 triggers a full reassessment. The tax basis jumps from $300,000 to $2.5 million. Their annual property tax bill skyrockets $3,300 to around $27,500. The dream of a rental income is instantly wiped out. It's a financial nightmare. Now let's say one child, Maria, decides to move in and save the tax base. She does everything by the book and establishes at her primary residence within a year. She thinks she's protected, but here comes the math. And by the way, the $1 million exclusion is adjusted for inflation each year. So by 2026, it might be slightly higher, but we'll use the base $1 million for this example. First, we'll figure out the taxable amount. We take the home's current market value, $2.5 million, and subtract the parent's original assessed value, $300,000, and the $1 million exclusion, $2,500,000 minus $300,000 minus $1 million equals $1,200,000. This is the new taxable amount. Now we add that back to the parent's old assessed value to get the new total. $300,000 original, $1,200,000. The new taxable amount equals $1,500,000. This is Maria's new assessed value. Her new annual property tax bill will be roughly $16,500. Better than $27,500, but it's a shocking 400% increase. She followed the rules, but the hidden trap of the $1 million cap is still sprung, leaving her with a 5-figure tax bill she never saw coming. If your head is spinning right now, that's okay. It's a lot to take in. These are high-stakes decisions with complex financial and legal consequences, and trying to navigate this alone is a recipe for disaster. This is the exact moment where getting expert advice isn't a luxury. It's an absolute necessity. If you're facing this, please talk to an experienced estate planning attorney or a tax professional who gets California property rules. Don't wait until it's too late. So if you've inherited a home, what can you actually do? You're standing at a fork in the road with 3 main paths. Path 1, move in and take the tax hit. Just like Maria, you can move in and claim their home as your primary residence. This is your only chance to keep any part of that old tax base. But you have to run the numbers first. Use the formula we walked through to figure out what your new tax bill will be. Don't assume anything. Be ready for a big jump and decide if you can truly afford it. Path 2, sell the property. For many families, this is now the most practical option. The new massive tax bill simply makes keeping the home impossible. Selling might feel like a gut-wrenching decision, but it's often the smartest financial one, and there's a huge silver lining here. The step-up basis for capital gains taxes. When you inherit a house, its cost basis for tax purposes is stepped up to whatever it was worth on the day the owner passed away. For the Garcias' $2.5 million home, the new basis isn't the $150,000 their parents paid. It's the $2,500,000. The kids can turn around and sell it. They will likely owe little or no capital gains taxes. It's incredible. Path 3, a buyout. What if your siblings, one wants to buy the house? This usually means getting a mortgage, and the bank will absolutely use the new higher property tax bill when deciding if they can afford the loan. This path requires financial planning and solid legal agreements between family members. The rules for inheriting property in California have completely changed. That simple golden promise of the parent-child exclusion is a thing of the past, replaced by a complicated, restrictive system that trips up the unprepared. Here are the 2 things you absolutely must remember. First, to keep any tax benefit, an heir must move in within 1 year and file the exemption and exclusion. Second, even if you do, the 1 million value cap can still trigger a massive property tax increase. Do not make a single decision about an inherited property. Don't transfer the title, don't sign anything, don't promise it to a tenant until you have talked to a professional. The choices you make in that first year will have financial consequences that last for decades. Understanding these new rules is the first step toward navigating this reality and protecting your family's hard-earned legacy.